So even if you generate 12% return, you double your money in 6 years. In fixed income, if you're making 4.5%, it will take you 15 years to double your money. So that is the other thing we have.
So, for the benefit of the investors that who have joined here now, let me just quickly introduce Sunil sir. So, Sunil sir brings about more than 3 decades of experience on the table. Well, he doesn't need any introduction because you might have followed him on various business channels like CNBC or Z Business. Well, he is the founder of and the chief investment officer, I would say, at Abakkus Asset Management. So they started the journey 6 years back, and as we speak, they're managing about a $4.5 billion of asset under management. Sunil sir has a very successful track record working with Reliance Mutual Fund, because those days it was called Reliance Mutual Fund, which eventually became Nippon Mutual Fund, where he spent about more than 2 decades, and under his able guidance, the fund Nippon India Growth Fund grew more than 100 times. So someone who has seen multiple cycles, and someone for we've got a lot of requests. He's here, so I don't want to come in between the investor and Sunil sir. So Sunil sir, over to you without any further ado. Thank you so much for accepting our request.
Thanks a lot, Vikas, and thanks for all the good words. Just to correct, we are $3.5 billion in assets, around 32,000 crores. But thanks a lot to everyone for blessing us always, for the good wishes, and obviously for allowing us to manage money on your behalf. I don't have a presentation, frankly, because I think it's become very cliched. All the presentations look alike, and everyone has seen it so many times. So I think this is the trend of Man Ki Baat. I'll try to give my perspective on investing, our journey, very informally. Obviously, because you can ask questions once I have done 15-20 minutes of speaking on your behalf and on his behalf. So, I've been an investor in India for a long time. Because you said 30 years, I think that makes me sound very old. But I think as a formal investor on a public platform, I began my journey in 2003 with Reliance Mutual Fund. At that time, it was Reliance Mutual Fund. I joined when the total corpus was only 35 crores. Madhu was there with me earlier than me, and luckily for us, the world started to grow post 2003. India grew phenomenally well post that, and we at Reliance did very well. And I'll give you some perspective of what we believe worked for us at that point of time. And I think from being the smallest mutual fund in 2003, 35th out of 35 mutual funds, in 5 years, by 2008, we were the number one mutual fund. We were the first mutual fund to hit 1 lakh crores in assets, which looks very small now, but at that point of time, it was a big milestone, because the number two mutual fund at that point of time was 60,000 crores. So there was a huge gap. So I think things have been pretty good. 2017, I thought to myself that all my life I have been backing entrepreneurs by investing in their companies. And despite the huge opportunity, I was chickening out becoming an entrepreneur myself. And I think that was the trigger point. It took me a year to convince my management to let me go. In 2018, set up Abakkus. And thanks to all your wishes and blessings, we have grown to where we are. The investment perspective has been the same for the last 20 years. And, the first thing which an investor in India has to have, if he or she has to be successful, is conviction in the country they're investing. So, styles and all are all there and important and not important. But ultimately, the basic characteristic which an investor needs is confidence and conviction that tomorrow is going to be better than today. Because equity investing is all about investing for the future. So any investor for the last 20-25 years who have believed that India will continue to grow has had great wealth, great health, and a lot of smiles. And those investors who have tried to reason out कि अभी ये कोरोना हो गया, अभी रशिया वॉर हो गया, अभी कुछ और हो जाएगा, अभी क्रेडिट स्विस का कुछ हो गया, अभी इलेक्शन हो गया, I think they have just found reason of either selling out whatever they had or not investing. So the first thing, as an equity investor, I think invest only if you are positive on the way forward, or on the country where you are investing. And I think that is where our view is that India stands out beautifully. It's again been talked about many times, but we got our independence in 1947. Took us 60 years. By 2007, we reached an economy size of trillion dollars. Sorry, the next trillion happened in 9. The third trillion happened in like 7. And after 77 years of independence, we are roughly 3.5, $3.7 trillion in economy. So cumulatively, as a country, we have created wealth to the extent of $3.7 trillion. Even if you grow at 7% and you take 3% inflation, I think this 3.7 can become 7 in a matter of 7 to 8 years. Someone who's bullish will say 7, someone who's not so bullish will say 8. But the direction is very clear. What this means is that the wealth which we have created cumulatively over the last 77 years, the same wealth is going to be created over the next 7 to 8 years. I think if you are convinced about this, then Indian equities is the place to invest. Obviously, returns will always vary. It is impossible to generate 30-40% year after year, because then all the billionaires will only be in India. But if you are satisfied with reasonable returns, I think there is still a lot of scope as far as India is concerned. The other thing is, I think if you look at the alternatives, you look at real estate, I think real estate has already reached maybe close to its peak as far as the long distance cycle is concerned. So, the cycles in real estate are very, very long. We have already had 5 great years of real estate, I think 4 years already, maybe a year or 2 more. But it's a long cycle asset class. I don't think anyone is going to buy real estate for investment unless it's, in some like a tier 2, tier 3 city or town. Then you have, bank deposits and other, fixed income instruments where post-tax you are able to generate 4-5% return. So I think in equity, even if you are able to generate 12 to 15% return, with lower tax, you can double your money, much faster than you would do it in a fixed income. So even if you generate 12% return, you double your money in 6 years. In fixed income, if you are making 4.5%, it will take you 15 years to double your money. So that is the other thing we have to take in. Third thing, which investors always get a little confused in whether it's the right time, and second, whether to invest in growth, value, whether to invest in large cap, mid cap, small cap, and that discussion keeps on going. People keep on shifting from one fund to another. You don't realize, but you end up paying taxes, impact cost. You miss out on a few rallies and so on and so forth. I'll touch all of this, as I speak. But I think from our perspective, India offers a lot of opportunity, and I'll just touch upon 2-3 minutes on that, and then come to what we follow at Abakkus as our investment philosophy. So one is very clearly, if you see post-COVID, the world was debating whether there will be a recession or 0% growth. In India, we were debating whether we'll grow at 6% or 7%. And actually, we ended up growing upwards of 7%. In fact, last quarter, we grew upwards of 8%. And I think that is the reason why India stood out in terms of the global investors. That when the world is struggling to grow, this is a country which is still growing at 7%. Our view is that this is a function of the 4D, as we call it. And that 4Ds are only getting stronger as we move forward. And what are those 4Ds? One is democracy. I think in a world where people lost 100% in Russia because of country being led by one person, or potentially there is a risk of the same happening with other countries like China. I think very clearly, democracies are preferred destinations for any investor. And we have seen how 1 billion people voted very smoothly. The results are out in one day. You have whatever it is, and you move ahead as if nothing has happened. And I think that clearly gives a lot of strength, lot of conviction to global investors. And I think India stands out very clearly in terms of being a very vibrant democracy. Second is the demographics. We all know India is a young country, but there are some interesting data points. Our median age is 29 years. Even after 20 years, our median age would be like 35. Almost 65% of our population, even after 20 years, would be below 60 years of age. And I think that basically means that the longevity of this growth rate of 6.5%, 7% is very, very strong in state. The other thing is, out of the 140 crore people we have right now in terms of our population, only 40 crore people can afford some kind of bond who have income levels of more than 6 lakh rupees a year. The rest 100 crores are just struggling to meet their roti kapda or the basic needs. After 10 years, this ratio will completely change. Out of the 150 crore people we'll have there at that point of time, almost 100 crores will be able to afford some wants. And only 50 crores would be in that need category. So this 40 crore who can afford some wants going to 100 crores who can afford wants is a 60 crore addition, which is equal to almost the entire population of US and Europe. And when this 40 crores goes to 100 crores, you imagine the kind of consumption boom we'll have across. And I think that would be a kicker for all kinds of economic activity, because you'll need more infrastructure, you'll need more transportation, you'll need everything more. Again, that gives a lot of confidence of the longevity as far as this growth rate is. The third D is the domestic demand. I mentioned that when the world was struggling to grow, if you just recollect, just after COVID, Indians were busy celebrating weddings, anniversaries, birthdays, traveling like nobody's business. Hotels were not available, flights were not available. Now it's very, very difficult. And the reason is we are completely domestic driven economy. 82-83% of our GDP comes from domestic consumption. And therefore, it meant that when Europe was struggling or degrowing, or US was struggling, or even China was struggling, in India, we continue to grow because of the huge sort of domestic consumption-led economy. The last D is the digital economy. I think we lag massively in terms of infrastructure, though there is some headway in there. But what we lag in terms of infrastructure, we have more than made up by way of our digital economy. I think in terms of technology, digital way of doing business, I think India is far, far ahead. You can transfer smallest of smallest denomination of money between two people for almost free. Tax collections are growing at 20%, not because we have suddenly become very, very compliant, but because now with this digital way of working, it is impossible to, not be very, very compliant as far as our, taxation is concerned. So these 4 Ds have been the major reason of India growing at 7.5-8% for such a long period of time. And I think this is going to lead to this 7.5-8% growth even going forward. The other thing which we have to watch out for is what the government has been trying to do over the last few years, and what therefore they will try to do over the coming few years. So the first term, which was 2014 to 2019 of the Modi government, went into cleaning the system. There were a lot of NPAs, a lot of inefficiencies. I think the first whole 5 year went into DMON and GST and cleaning the NPAs of the banks and so on and so forth. The second 5-year term, which is 2019 to 2024, half of it went into COVID. It's only in the last 2.5, 3 years that we have seen this whole resolve towards indigenization, Make in India, PLI scheme, manufacturing, electronics, defense, railways, everything, increasing the infrastructure spend, and so on and so forth. Our view is that the next 5 years, based on the statements which have been made in the manifesto as well as post the elections, are going to be the takeoff period for a lot of these initiatives where the groundwork has already been done between 2019 and 24. So in the budget of 2023, infrastructure spending was 10 lakh crores. In the interim budget of 2024, it was increased to 11,000,000. Now, if every year they keep on increasing it by 10%, over the next 5 years, we are going to have almost 65 lakh crores being spent on infrastructure, which is incidentally significantly higher than the total infrastructure spent over the last 77 years since independence. So imagine what we have created over the last 77 years. More than that is going to be spent over the next 5 years. And I think all these have the potential of driving India to Viksit Bharat or developed India over a period of time, which is what the Honorable Prime Minister has been talking about. And I think given all this, our view is that India offers a great opportunity for investment. Only thing is, you can't keep on making 30-40% year after year. And our view is that at the current valuations of Nifty, which are roughly 17.5 times FY26, our view is that returns should be more aligned to the profitability growth of the underlying companies, which will be somewhere in the low to mid-teen kind of. From Abakkus perspective, our view is that we are investing in the listed space, and I would touch upon the growth, value, and mid cap, small cap in the same conversation. So we are looking at investing in companies which are stable, which make profits, where there is discipline in terms of capital allocation, and where there is visible growth. And I think all that basically makes us believe that we are in a much better situation, because we are not leaving anything to chance. It is all about picking a partner in the business. So few things which we try to do is, one, as I mentioned earlier, we are very profit focused and we are very balance sheet focused. And when you look at growth versus value, I think a lot of times we sort of misconstrue a growth stock and a value stock. Now, what is a growth stock? Just because a company is working in a consumption sector or a pharma sector or a IT sector or some exotic sector, does it become a growth stock? So to give you an example, IT is supposed to be a growth sector, but last couple of years, their growth has been less than 10%, and going forward also their growth is expected to be more in like mid-single digits, not even double digits. Or even staples, the likes of Hindustan Lever and all are growing at 5-6% in terms of volume. So why are they called growth stocks? The largest paint company grows at 10-11%. It's considered to be the biggest growth stock. So just because historically we have been said that these are growth stocks, do we believe that these are growth stocks? What is the definition of growth? Growth is something which grows faster than the at least other companies or other parts of the economy. So just because someone has told us that this is a growth stock, doesn't become a growth stock. You have to at least look at what has been the growth been over the last 3, 5, 7, 10 years. The other thing is every stock has a price. So we always believe that the best company is not necessarily the best. Sometimes the best company, whether it's Asian Paints or Hindustan Lever or XYZ, they are great companies. They might not be the great stocks if they are priced beyond perfection. Because ultimately, what you pay for a stock is dependent on many things. Obviously there's management, but also how much profit they are going to make and what is the growth rate going forward, because you are investing for the future, as I mentioned earlier. And you will invest in a company based on the future growth, future profit, and then you will discount it and give a value to it. So I think the second thing which we have to basically be very clear is that the best company might not be the best stock if it is priced beyond perfection. Third is growth is in the minds of the analyst or the person who is tracking it. We don't even know what the next month growth would be or the next quarter growth would be. Here we are extrapolating growth for 20 years and we are saying that this company is going to grow at 10% for 20 years, 30 years, 40 years, and so on and so forth. So I think one has to be very clear that you can project or estimate up to a particular time frame. You can't estimate forever. So, if you are willing to pay a 70p stock, that means you're expecting the company to grow significantly for a very, very long period of time, which might happen, but which is not predictable at a particular point of time. And the other thing is, everything has a value, and the value is also dependent on growth as well as a lot of other things. So I think somewhere growth and value will go hand in hand. You just can't say that growth will do better than value, value will do better than growth. That are all phases which keep on happening. But ultimately, both of them have to grow together. So one of our frameworks, we also have earnings growth as our criteria. So we typically like to invest in companies where profits can double, ideally in 4 years or maximum of 5. So where we are finding value, there also we are looking at growth. So I think somewhere down the line, this growth versus value, debate goes to a very, very different kind of tangent. Uh, what we might construe as growth stocks might not exactly be growth stocks. Growth stocks would be stocks which will grow 35-40%. Usko growth bolo, 20%, 25%. Those are growth stocks. Just because someone is in the consumption sector or a pharma sector or an IT sector does not mean that those companies are growth stocks. Last is, see, at some point of time, everyone has to take a call. And our view is that we like to be the first or maybe the only investor. But to take that call, one has to be very clear, very thorough in our analysis, and also very clear on what you're paying. So many times, stocks languish because कोई ना कोई reason आया था. अभी हमने Oracle लिया था, बोले growth नहीं है. It is only growing at 5%. But our view was that the other sector of IT is also growing at 5-7%. They are trading at 30p, and this company is growing at 5-6%, trading at 13p. And there is a possibility that in the next 2-3 years there might be growth which will come in. एक quarter में growth आया था, stock doubled. So I think, but for you as an investor to do that, you will have to have patience, and you should also have the conviction of analyzing the stock thoroughly, knowing what would be the downside if it doesn't work out, knowing what will be the upside if it really works. Because if you just buy something which is construed to be growth and which is in fashion, then you don't know how to react when things turn. So, on the election day, if you see, most of the so-called growth stocks were down 25-30%, like railways and defense and so on and so forth. Obviously, there was this election concern, but also because fundamentally, anyway, they were expensive. So, when it's fundamentally expensive, and if there is a little bit of I would say, question mark over the future potential of growth, you will always have these sharp corrections. So, in short, our view would be that when you are investing in the listed space, invest as if you are becoming a partner in the business. If you are willing to buy 100% of a company at that price, then you buy stock. Otherwise, you yourself know that it is expensive. If you're not going to buy 100% of the company, if you have the money, then why should you buy any percentage in that company? And we are in the listed space. In the listed space, you want sustainability of return. You want compounding of return. You want to make 15-18% year after year, year after year, year after year. And that's how, funds become 100x, 200x, 300x. Stocks also become like that. Because if you're going to just keep on chasing, things now and then you will keep on changing sectors, you will keep on changing, your perspective and so on and so on. So I think this debate of value versus growth will always be there. But for one to be convinced that this is a growth stock, one has to see whether there's actually growth. And at least from our perspective, as I said, we are value conscious, but our view is that unless there is growth in profitability, where profits can double in 4 to 5 years, significant returns cannot be made. Market price of a particular stock is equal to EPS into P. That is a simple definition. So if the EPS is 50 and you give a 20p, then the price of the stock will be 1000. EPS is the profit making capability of the company, how much profit the company can make. P is the perception, which you, me, and all the other investors put together give. So for the same profit, one company trades at 5p, the other company trades at 50. I think the best thing is you find a stock where earnings can grow and where the perception right now is not great, so the P is low. And as consistency of earnings increase, the perceptions can also increase. So if you have both earnings and perception of the P going up, that is how you'll end up generating alpha or generating a multiplier. So this would be a short sort of synopsis from our side. To just summarize, I think one, India is looking good. One should be an equity investor only if they are convinced that the country, which is India, they are investing in has great potential. Second is, one has to be very clear of what kind they are investing in. At least from our perspective, as I said, we invest only in profitable companies, only where there is visible profit growth, and where valuations we pay justify owning the entire company as a business. So with it, I'm open to answering any questions which you have, Vikas, at this point of time. Thank you.
No, thank you so much for sharing your valuable wisdom with all our investors. And yeah, what you rightly said, this debate can continue for next 1 hour, 2 hour, and this will never be. But if someone would ask me that, Bacchus, of course, we talked about it, your positioning is well clarified. But if someone would ask, where would you like to be, Sunilji, value side or growth side, then what would be your answer?
No, so I mentioned to you, we are value conscious. So if you tell me that you buy a 50p stock, we will evaluate, but only if there is growth which justifies that. So I would say that we are in that camp which is willing to live with a 15-17% return consistently for a long period of time. And those returns are out of the profit growth of the company. So I think we are value focused, but the company should have growth in profitability. So I would say that value at a reasonable price is a misconcept thing, but I would say that we are value conscious, but unless there is growth in profitability, you don't make return. But growth has to be growth in profitability, not just perceived growth stock.
Yeah. The other side is growth at a reasonable price would also be would not fit into, because you said that there has to be. I mean, for you, value could be something else, and price could be something else. For me, it could be something else.
Yeah, we don't believe in the theory of buy at any price or growth at any price. That doesn't work. Everything has a price. So if iPhone I'll buy for 1 lakh, I'll buy for 1.5 lakh. If it becomes 5 lakh, then I will buy a Samsung. I'm just giving you a perspective.
Sure.
So, growth at any price or buy at any price doesn't work.
And the intrinsic value that people talk about, 20 years discounting, paying 70 ka P, 80 ka P. So on the other side, saying that India is a growth.
आपके लाइफ में आपने कितनी चीज 5 साल बाद की आपने है ना एक्यूरेटली है ना फोरकास्ट की या 2 साल बाद की एक्यूरेटली फोरकास्ट की, कहाँ 20-20 साल का हम सर हम करने डी
Maybe last two questions.
There are so many disruptions, so many businesses have just gone out. I always say हम न्यूज़पेपर पढ़ते हैं, बच्चे थोड़ी न्यूज़पेपर पढ़ रहे हैं. All our entertainment is now on the OTT platforms of Netflix and Amazon. अभी कौन सास बहू और ये सब देख रहा है स्टार? Yeah, in automobiles, things are moving towards EV. At some point of time, they will move. In power, things will move to solar. So there are a lot of disruptions happening. पहले हम रेस्टोरेंट जाते थे, अभी रेस्टोरेंट घर पे आ रहे हैं. So I think we have to be aware that nothing is going to be sacrosanct. After 20 years, the way we live is going to completely change. Then how can you forecast 20 years ahead?
Too well said. So with that, we'd like to conclude the session here. Thank you so much. It was a pleasure talking to you. Many thanks for